Good evening, everyone. My name is David Yan, and I'm the VP of Wealth Management at Envision Financial. Welcome to our virtual member event titled Your Investments, Market Review and Outlook. At Envision Financial, we believe it's very important to educate our members so that they're more informed when they make decisions. And for those who've been around for the past 4 or 5 years, we've been hosting various presentations at our branches on a variety of topics, including cybersecurity, financial literacy, retirement planning, and estate planning. With the pandemic, we've not hosted any of these presentations this past year. However, we thought it would be timely to have a presentation regarding the markets and the investment climate, especially in light of the recent US election, the global pandemic, and the low interest rate environment. I'm hoping that the majority of you are investing with us here at Envision Financial, and most of you will probably hold some of the NEI funds. With that in mind, we thought it'd be prudent to have today's presenter be Yufei Man, who's the Director of Asset Allocation and Investment Strategy for NEI. Yufei joined Visa Wealth in 2013 as part of NEI Investments. In his current role, he oversees research, portfolio construction, and trading across all of NEI's multi-asset solutions. Prior to NEI, Yufei was an investment analyst at a Toronto-based long-short equity hedge fund. Yufei holds both the Chartered Financial Analyst designation as well as the Chartered Alternative Investment Analyst designation. So before I pass it over to Yufei, I just thought I'd give you guys a quick agenda for this evening. Yufei will be presenting on the markets, what happened in 2020 and what to expect going forward. He'll discuss briefly some investment strategies and investor biases, and also give you an overview of NEI and how they adjust their portfolios depending on market conditions. So with that in mind, again, we thank you very much for joining us this evening, and I'm going to pass it over to Yufei Man.
Okay, great. Good evening, everyone. Thank you for joining us today. Thank you, David, for the introduction. As a portfolio manager, it's not often that I get to speak directly to our investors, so I really do appreciate you having me here today. Topic is your investments, market review, and outlook. So here's the disclaimer, if we have to show that. So let's start with the market review and outlook. So here we break down our market outlook into short-term and long-term views. In the short term, we've seen very strong stock market momentum over the last couple of weeks. Markets reacted very positively following Biden's win in the US election. And of course, the other big news was breakthroughs in the coronavirus vaccines. Now, a vaccine would be a major game changer as it would eliminate the need to physical distance. And that, of course, would help accelerate our economic recovery. Now, that being said, it could likely be, the second half of next year before we actually see a wide global distribution of this vaccine. And in the meantime, as we're seeing here in Ontario, where I am, and also in BC, virus cases continue to rise. Lockdowns are being put back into place, which of course drags on economic activity for the fourth quarter, despite the strong activity that we saw over the summer months. So as things continue to be locked down, and it's all around the world, it's not just here in Canada, it's important that governments provide the necessary fiscal support to help keep small businesses and individuals afloat. Now, over the long term, we remain very optimistic on equities. The bear market that we saw in March, it was the shortest one in history. And in fact, since April, we've been in a bull market ever since. Now, the economy may take several years to recover, but markets can be very efficient and can very quickly discount positive developments, as we've seen over the last couple of weeks. When news of a vaccine broke, markets were up like 5% in a single day. So if you're a long-term investor, consider that the average US business cycle lasts about 5 years. And we're right at the beginning of that next business cycle. The first quarter and the second quarter, we saw an economic contraction, which means we had a brief recession, but growth in the third quarter was very positive, and growth in the fourth quarter is also expected to be positive. And so our recession is very well over. And so going into detail on every asset class, our belief is that stocks should outperform bonds over the next 3 to 12 months. Within stocks, we like US and emerging markets. We're fairly neutral on Canada as well as international markets, and international markets would include the UK, Europe, as well as Japan. For bonds, we're underweight, especially in government bonds, as interest rates are going to be pretty much anchored low for the next several years. So don't expect a lot of your returns to come from there. However, corporate bonds, they remain attractive. The spreads that you're getting paid to take that extra credit risk, it's very, very attractive levels, and as well as in high yield, we're seeing some opportunities there as well. So for the next couple of slides, I'm going to go into a little more detail on different segments of the market. Some of this can get a little technical, so I'm going to try to explain as best as I can. So let's take a deep dive into the stock market. So, I want to first talk about what happened in markets so far this year. So prior to 2020, we were in this incredible 11-year bull market, and it was the longest bull market on record. Now that all ended on February 19th, which at the time was the all-time high for the stock market as COVID-19 spread. Social distancing measures had to be taken, which resulted in many parts of the global economy being forced to shut down, which means in many ways, this was a man-made recession or a manufactured recession. And that's what makes this year's market downturn different from previous ones, such as the 2008 Great Financial Crisis, which is all still relatively fresh in our minds. And this time is that we saw major disruption to both the supply and the demand side of the global economy, right? So what does that mean? Well, in this case, a supply shock was created when governments issued social distancing measures, which forced people to stay home and therefore leading to a reduction in the workforce. So when you have less people working, it leads to lower productivity and therefore lower economic growth. Now, the virus also created a demand shock. And what that means is, if you look at travel restrictions and people staying indoors, it means entire industries such as airlines, leisure, tourism, retail, hospitality, they've all been very hard hit. Now, most developed economies rely on consumer consumption as a primary driver of growth. And in fact, here in North America, whether you look at Canada or the US, about 2/3 of our GDP comes from household spending, right? So this sudden halt in economic activity put us into 2 quarters of recessions that was worse than actually what we saw during the 2008 Great Financial Crisis, but we also recovered a lot quicker. Now remember that stock prices reflect future expectations for economic growth. So as soon as lockdown measures started to be announced, the market started dropping. And in fact, the pandemic sell-off that we saw this year was record-breaking by many measures. So I'm just going to throw some numbers here at you. So between February and March, we saw the fastest ever descent into a bear market as the S&P 500, which is the popular index that measures the US stock market, dropped 35% over 6 weeks. And then between April and August, the S&P 500 saw its strongest ever 5-month rally in 80 years. And as you can see on this chart, we went from all-time highs on February 19th, we bottomed out on March 23rd, and then we went right back to all-time highs on September 2nd. And then between September 2nd and November 13th, which was the next or the most recent all-time high, we saw a bit of market volatility. There was some, investors were a little jitterish leading up to the US elections. We also saw some delays in passing the next US fiscal bill, and also seasonality as well, as September is usually one of the weaker months in the market, but we're right back at all-time highs. And of course, a lot of that was driven by the positive news that we saw over the last couple of weeks around the vaccine. Now, let's take a step back and look at the bigger picture. So this year we saw a bear market. Now we're back into a bull market. Now, if you look at history, so this chart here goes back to 1960, and it shows all of the different bear and bull markets that we've seen since 1960. And notice, well, there's 2 things, right? Notice that there's a lot more blue on that chart than there is orange. Blue signifies bull markets and orange signifies bear markets. So what that means is that during bull markets expand. They last a lot longer, and also they gain a lot more than the losses that you see during bear markets. And the other thing is that markets move in cycles, right? You cannot have a bull market without a bear market, and you can't have a bear market without a bull market. One comes after the other. And so because we've just seen a bear market, and now we're back into a bull market, and if you look at this chart, the average bull market lasts 61 months. So it's just over 5 years. And we've been in a bull market since April. And going by history, it means we still have some ways to go in this bull market. Now, our outlook for bonds. So as I mentioned earlier, the story, it's not going to be that exciting for bonds going forward, but that's okay, because bonds did exactly what they were supposed to do back in February and March. They protected on the downside as markets sold off. But going forward, we're not going to expect significant returns from government bonds as interest rates will likely be pinned for the next few years to help sustain the economic recovery. This chart here shows the yield on the 10-year Government of Canada bond. So the term yield is basically your average annual return that you would receive if you bought a 10-year bond today and you held it all the way to maturity. So that's for 10 years. And if you look on this chart, for the last 40 years, bond yields have been on the decline. There's an inverse relationship between bond yield in bond returns. So a decline in bond yields actually results in higher bond prices. And as you can see on the very far right end of this chart, that sharp dip in yields resulted in the positive performance in bonds that we've seen since February. Now, currently, a 10-year Government of Canada bond only yields about 0.7%, which is roughly the return that you can expect to receive by holding the bond all the way to maturity. Now, as I mentioned, corporate bonds, they pay you a little bit more, but you're also taking additional credit risk that's related to the company that's issuing the bond. But all that said, it doesn't mean that you should go and sell all of your bonds now, because they still provide important downside protection during periods of market volatility. Now, this next chart shows gauges of economic activity, or in this case, expectations of economic growth across major areas, so US, Eurozone, and Japan. And we saw this very sharp V that, during March, when the pandemic struck, expectations of economic growth went down, but they very quickly recovered. Then we saw a very strong few summer months as the economies reopened and people were out and about, and that of course spurs economic activity. But then over the last 2 months, as you can see, there's been a sharp drop as second and even third waves of the virus came about, and of course governments had to reissue new lockdown measures. Now, on the Canadian dollar, so how you look at this chart, so this is how much it costs in Canadian dollars to buy $1 US. So the higher on this chart means that Canadian dollar is actually worth less relative to US dollar, and lower on this chart means that Canadian dollar is worth more relative to the US dollar. As you can see, for the Canadian dollar, it's a very cyclical currency. And as you can see, back in March and April, the US dollar went up in value a lot during that pandemic sell-off. And because it usually does during periods of market stress, it's considered a safe haven currency. So during periods of market volatility, investors tend to buy more US dollar assets. And if you look at those gains back in March and April, and now it's almost completely reversed, right? So we're right back to where we were at the beginning of the year. And going forward, as the global economy continues to recover, and as investor confidence comes back and commodity prices continue to recover, we can expect continued strength in the Canadian dollar. So you can expect that this chart to move a little bit lower for the next year. Now, on crude oil. So when you think about back in March, when physical distancing measures were first announced, global travel basically came to a halt. And with that, also the demand for fossil fuels, it also plunged. Now, so this is a chart of crude oil futures prices. So futures, it's basically a financial instrument that allows you to buy an asset at a certain price, not today, but sometime in the future, and so hence the name futures. And so back in March, what happened was that crude oil futures traded at negative $37 for a brief moment. And it's that sharp drawdown that you see there back in April. And the reason is that when you buy an oil future, the futures contract comes with an expiration date. And when it expires, you have to take delivery. But because of the pandemic and the drop in demand for oil, no one wanted to take delivery, because once you take delivery, you have to store it somewhere, and no one wants to deal with the excess supply because there's storage costs associated. But now oil has mostly recovered. As you see, it's hovering roughly around $40 a barrel. We're still ways off from the pre-COVID levels of demand, but as I mentioned before, as a vaccine is eventually made widely available, people start traveling again, we can probably expect crude oil prices to continue to recover, and that goes along with strengthening of the Canadian dollar, because our economy obviously is very much tied to energy prices. Now, in terms of the global economy, now looking forward, here are the latest projections from the International Monetary Fund. So this year, we can expect about a 4.4% contraction in global GDP, followed by a nice 5.2% growth for next year. So what this means is that the worst is likely behind us. However, it will take several years for things to get back to normal. Now, a vaccine would definitely help accelerate this recovery. But again, like I said, taking into account the approval process, the manufacturing time, and global distribution, we probably, it won't be widely globally distributed until well into next year. So this year, the global economy is expected to contract 4.4%. Canada is actually expected to do a little worse than that. So our economy this year is expected to contract 7.1%. And as we know, as I mentioned, Canada has a large fossil fuel sector. So in addition to lockdowns, which is hurting the economy, the drop in oil prices, it's like almost a double whammy, and it's also hurting our economy. So a little bit more than other developed economies. But on the other hand, our government response in terms of fiscal and monetary measures has arguably been very strong as well compared to the rest of the world. So speaking of government response, this chart here shows how much every country this year has spent on fiscal measures relative to their GDP. And you can see that Canada and the US are leading the pack. As long as the virus continues to spread and our economies only stay partially open, we will require further government support. So back in March, when stock markets around the world were plunging, central banks had to step in and restore confidence in the financial markets. They cut interest rates to zero. They announced record asset purchase programs. And at least for the next 2 to 3 years, we'll probably see interest rates anchored close to zero. But that also means that central banks are increasingly running out of tools to stimulate the economy. Because what do you do when central bank balance sheets are at record highs and interest rates are at record lows? Well, as you probably can guess from the title, we will increasingly see fiscal policy take center stage, whereas monetary policy is often referred to as a blunt instrument because it really largely benefits the financial system, it benefits Wall Street and financial firms. Fiscal policy can have much more precision. Governments can have spending programs that directly target those in need. And in this case, it's really the individuals and small businesses that have been displaced by the virus. Now, despite markets back near all-time highs and the economy seeing positive growth for the third quarter and likely for the fourth quarter, labor markets have not fully recovered, and we're still seeing a large number of permanent job losses. So it is absolutely imperative that governments provide support where they can. Now, there are those that, of course, worry about the increase in debt levels and what that does to the future and to the value of our Canadian dollar. But at the same time, consider that this is a global issue. So literally every single country is doing this. And you can see on this chart the amount of fiscal stimulus that we've seen this year. It does mean our government debt levels are increasing, but with interest rates expected to stay low for some time, the burden of servicing that debt should also remain quite low. And because the government controls the money supply as well, any negative impact from increasing debt levels should be pretty well contained. Now, my last chart on this, with all of this government spending, it does create some once in a generation opportunities. Now, for years, right, we've been talking about climate change and how many have argued it is the single greatest risk factor over the next decade. And how can we mitigate this risk? And there's been talk of the need to transition to a low carbon economy. And there's many that are opposed to this because of the enormous costs that it would incur, right? We're talking trillions of dollars. Well, guess what? With these government fiscal stimulus packages, we now have trillions of dollars backed by central banks. And what we've seen this year so far, and you can see them here on this slide, is that every major economy have taken some measure to moving towards a greener economy. And I'm sure you can guess NEI's stance on this. We're a leader in responsible investing. We welcome this with open arms. And it's not enough to just make the transition to a low carbon economy. It also needs to be a sustainable transition so that the net effect is job creation and not job destruction. And now we have the funding to achieve that. And so, being in the middle of this global health crisis, here we have an opportunity to slow down or even stall global warming and climate change. And it's something that I think all of us can probably look forward to. So now for this next section, I'm going to introduce 5 tips on how you can be a better investor. And for this section, investing, we call it investing strategies, but investing strategies refers to not so much what you should invest in, because I've talked about that already. I talked about the market outlook, but this section talks about how you should invest, because often how you behave as an investor is a much greater determinant of your long-term investment success. So let's get into this. So first, diversify, right? You've all heard this before. We all know it's important to diversify our portfolio, but why? First of all, more than 90% of your portfolio's volatility comes from your asset allocation. So asset allocation, that's you figuring out what types of stocks and bonds you want to have in your portfolio. What's your ratio of stocks to bonds? Because stocks, they're a little bit riskier, but they also generate higher return potential. So that's where you want to work with your financial advisor, figure out what's your risk tolerance, and having the right asset allocation helps you manage more than 90% of your portfolio's volatility. And as an example, if you look on this chart, there's colors all over the place. Every color represents a different asset class. And as you can see, every single year, it's always a different asset class that performs the best. They're sorted from best to worst. So your best performing asset class one year could be the worst performing asset class the next year. So that's why you want to make sure you don't put all your eggs in one basket. The second point, stay invested. I know that seems really simple, but oftentimes during periods of market volatility, and when you start seeing potentially losses in your portfolio, it's very tempting to get out and potentially thinking you might avoid further losses. But what this chart here shows is that staying invested actually makes a huge difference in your investment success. So if you only, so looking at this chart, if you were invested every single day from January 1988 to December 2019, you would have, if you invested $10,000 back in the day, you would have $265,241. Not bad, right? But if you had just missed the 10 best days of the market in that time, from 1988 to 2019, if you only missed just the 10 best days, your portfolio will be worth $132,371. That's less than half of what you could have earned. So that 10 days makes a 50% difference. And then, of course, if you go further to the right, missing 30 days, you'd only left with 54,000. And if you miss 60 days, so if you got out of the market for 2 months, and if you happen to miss the best 2 months of the market, you would have only been left with $18,000, which is still positive. But if you look at that, that opportunity gap right there. And so it's very important to stay invested through all market periods. And when you stay invested, what you're also doing, assuming you're making regular contributions to your portfolio, is that you're also using this tool called dollar cost averaging. And what it really does is that, in periods of markets, there are times when markets kind of go sideways for some time, which is what we've seen from September basically up until now. We saw an all-time high, markets dipped a little bit, there's some volatility, and now we're back at all-time highs. So from September to now, markets have been pretty much done nothing, right? They're pretty much flat. But in this time, if you've been making regular contributions, then what you're doing is you're dollar cost averaging. You're buying at the low. So you have periods when markets are down, and then you're buying in at lower prices. And so that actually gets you a better average price over time. Now, the fourth tip is time horizon. And this is really important because whenever we talk about investing, and you saw this when I gave my market outlook, time horizon really matters because you want to be deliberate, you want to be intentional as to what your investing horizon matters. Because let's say if you're saving up to buy a house, for a down payment for your house, and let's say if you're looking to buy in the next month, should you be putting all that money into the stock market? Probably not, right? But if you're saving up for retirement and your time horizon, is 10, 20, 30 years, then absolutely, right? You want to make sure that you're taking an appropriate level of risk to help you reach your investment goals. And so what the chart here shows is your distribution of returns. So how much dispersion there is in your return outcome, looking at a one-year investing window, a 3-year investing window, and a 10-year window. Notice that the black dot, which shows the average return for those periods, is the same, right? Because it should be the same. Your average return doesn't matter over what period. Long-term stock market returns, in this case, is the same across all the different windows, but your dispersion is a lot different. So if you look at your 1 year, you could be up more than 60%, or you could be down 30% if you're only invested for a 1-year period. But as you move to the right, and as you go to a 3-year window and to a 10-year window and a 10-year window, your dispersion is a lot narrower, right? You have a small chance that you might lose something, but on the other hand, most of your returns are actually positive in the 0 to 20% range, right? So it's very important that you are explicit with your time horizon and you set that expectation for yourself. So when I talk about investing strategies, this is a very that I thought it was a quote that really resonated with me. So Benjamin Graham, and he's one of the famous investors, and he was actually a mentor to Warren Buffett, and he said that the investor's chief problem, even his worst enemy, is likely to be himself. And this goes back to what I mentioned, is that investing strategies, the keys to success, it's not always about predicting the markets, because let's be honest, no one can perfectly predict what markets are going to do, but you can control yourself. And the reason that this is really important is that we all, as investors, and we're all human, we exhibit what's called behavioral biases, right? And the idea here is that if you think about most finance theories and how we model the markets, the underlying assumption is that people are rational, that investors are rational. We make rational decisions. But then if you look at markets and you look at price bubbles form, then they shouldn't form, right? If we're perfectly rational, we should not have bubbles. We shouldn't have the dot-com bubble of 2000, for example. And the idea is that markets are efficient for the most part but they're not perfectly efficient. And investors do exhibit behavioral biases. Now, there's an entire field of study on this, and it's called behavioral finance. And what they do is they apply neuroscience and psychology to the field of finance. And so I'm going to go through some of these behavioral biases, very common ones, and let's see if you can identify or resonate with them. So the first one is called anchoring bias. And what anchoring bias means is it's our tendency to anchor ideas and opinions to a particular reference point. And even though that reference point may not have any logical relevance to the decision at hand. And so in everyday life, how many of you have ever bought something because it was on sale? The original price was marked $100, that was crossed out, and now it's $50. Pretty good deal, right? But is that $100? Is that the real retail price? Is that how much that the thing is actually worth? We don't know, right? Sometimes prices get marked up and then only to get marked down. Similar to when we invest, sometimes you buy a stock. Let's say you bought it at $100, stock price goes down. You might feel like, oh, I need to hold on to this stock, wait for it to bounce back and get back over $100 so that I can at least break even before I sell it, right? But maybe something happened to the stock. Maybe it's intrinsically no longer worth $100. And that's why we have to get over these mental biases. The second point is availability bias. And this is our tendency to make decisions by placing more weight on recent information. And so, the financial media is notorious for this because, every day we're bombarded with news. And so when you read this morning's headlines, chances are you're going to put more weight on today's headlines versus what happened a week ago, right? And this is our tendency. We tend to, humans have shorter term memories, and we tend to focus more on more recent information. Now, the third point is confirmation bias. And confirmation bias is the tendency to selectively look for information that supports an existing idea, right? So, and when it comes to investing, oftentimes, let's say we bought a stock or we put our investments in, and you would look for positive news that supports your decision, right? Because you want to feel good about that decision. You don't want to feel regret. And so confirmation bias has us subconsciously seeking out information that supports our existing views. And the last point, loss aversion bias. Now, we're going to go back to the results of that survey to help explain the loss aversion bias. And the idea of loss aversion bias is that losses have been found to be psychologically twice as powerful as gains of the same magnitude. So in this case, gaining $900 versus losing $900, it affects you very differently. So if we could pull up the results of that survey. So let's just take a look at how you all responded to the first question. So in this question, 69% of you chose to receive $900 guaranteed. 31% of you wanted to take a gamble with a 90% chance to win $1,000, but there was also a small chance that you got nothing. Now, if we're all perfectly rational, the results should be 50-50, right? Because both outcomes, statistically speaking, your probability weighted outcome should be the same. So now let's look at the second question. Now, in the second question, again, exact same probability weighted outcome, but 85% of you would rather take a chance to actually lose more money for that small chance that you could lose nothing, right? So this just shows most of you, 85% of you don't want to lose that $900 guaranteed, and you'd rather actually take a gamble. In fact, taking more risk, right, with a chance to lose even more money just to break even. And so this, again, perfectly goes to show that we treat losses and gains differently. And this actually affects how we take risk and how we invest. Because at the end of the day, it's important to understand and conquer these behavioral biases because they affect how we take risk. And so just quickly talking about taking risk, there's two kind of components to taking risk. There's your ability to take risk, and there's also your willingness to take risk. And the two are very different because your willingness to take risk is actually affected by your behavioral biases, right? They can and they will change with the market cycle of emotions. You see this diagram here. As the market moves, whether your portfolio's showing positive gains or showing losses, that actually affects how you invest. As your portfolio gains in value, you get more confident, and chances are you might actually want to end up taking more risk than you can afford. And that's at that first part. You're in that euphoria, right? But then the market starts to drop, and then right at the bottom, which is actually the best time to get into the market, this is usually when people start to panic and they feel that fear and they don't want to lose anymore. And so they actually sell out of their investments, usually at the worst timing. Now, on the other hand, there is your ability to take risk. Now, your ability to take risk is really based on your financial situation, right? So this is something that doesn't change as frequently. I mean, of course, people go through different stages in life. Every few years, your life style, your financial situation, it can change. But this is something, it doesn't change as often as the market cycle of emotions. And this is where, when you work with a financial advisor, they help determine your ability to take risk based on your financial situation. And studies have actually shown that investors who work with an advisor make 2.73 times more wealth over, in this case, when you invest for more than 15 years, you get 2.373 times more wealth compared to not working with a financial advisor, because the financial advisor not only helps determine your ability to take risk, they also help you manage your willingness to take risk. And so they are your financial coach. And now, the very last part of my presentation, I wanted to introduce NEI Investments. And most of you, from what I understand, are investors with NEI Investments. So I wanted to take a moment to introduce NEI and who we are and what we do. So first, NEI is Canada's leader in responsible investing. This chart here shows all of the signatories, so all of the asset management companies that have joined on to the UNPRI. And the UNPRI stands for Principles of Responsible Investing. So this is a global movement. NEI joined in 2006 when the PRI was first established. And we were one of the first two Canadian signatories. The other one was actually BCI out in BC. And we were the only other asset manager that joined on. And if you look at over the years, that traction has increased. And 2016, 2017, 2018, we're seeing an exponential increase in the number of investment managers that are joining on, but we were one of the first. Second is that now around the world, there's over $1 trillion invested in responsible investing assets. Here in Canada, we have the largest market share and will continue to be the leader in responsible investing. So what does that really mean? What does it mean to be a leader? Well, in this case, we've engaged, so this is just in 2019 alone, we engaged over 152 companies. That means talking to management, trying to encourage companies to make positive changes. We voted on 10,775 proxy items. So as a shareholder, you do have voting power, and you get these proxy statements. Management wants to do this, this, and this, and we get to vote on whether we agree or disagree. We are active at 858 company meetings. So what that means is putting forth shareholder resolutions. So putting forth new proposals to to encourage management to obviously do changes for the better. And we undertook 25 public policy actions. So that's actually going beyond the company levels. This is sector-wide change. This is working with other investors, engaging government groups to making changes at a much broader level. And we've been rated A+ every single year by the PRI in terms of our corporate engagement approach. So another thing that makes NEI unique is that we have an open architecture structure. So what that means is we go around the world and we partner with different asset managers from around the world, and we bring them to the Canadian marketplace. So right now we have 18 external partners managing over $7 trillion of assets. So that's more than 4 times the size of the Canadian mutual fund market. And for NEI Investments, for those of you that are invested in one of the NEI portfolios, our philosophy to building portfolios is that we want to make sure that we protect on the downside, right? We want to participate during up markets, but we want to protect or lose less in down markets. And so the idea here is, if you look at this illustration, both portfolio A and portfolio B actually give you the exact same return, so 5%, and the exact same risk measurement, which in this case is measured by standard deviation. So 8% standard deviation, 5% return, but they look very different. And which portfolio would you rather invest in? I'm hoping B, right? This works a lot better when I'm with you in person, but we're all doing this virtually now. So I'm hoping that most of you would want a portfolio that's more like B. I know I certainly would. It helps me sleep better at night. But then those of you that, some of you might say, well, I'm a long-term investor, so it doesn't really matter because I'm not, both give me the same return. So why does it matter? Well, it matters because if you are taking money out, right? So if you're in retirement and let's say you're riffing out, then what happens is that it creates a path dependency, right? Because when you have those large drawdowns, whether it's early on or later on, it makes a big difference in your investment outcome. So the illustration here, using the same return pattern that we saw in the last slide, we applied it to an actual portfolio with a dollar value. As you can see, portfolio A draws down at a much quicker rate. Portfolio B, you actually accumulate wealth over time. So that's why it's very important to manage on the downside. Another thing about NEI is, when we think about responsible investing and being a leader in responsible investing, we're no longer just thinking about return and risk. Of course, return is very much important. Risk is very important. But now we want to start thinking about this third dimension. And so here it's really about your ESG objective. What is your responsible investing objective? What are you trying to achieve as a responsible investor? Is it, what kind of real world impact are you looking to have with your portfolio? And so this going forward, we saw, return, back in 1952, this guy named Harry Markowitz came up with this idea that, return comes at the cost of taking risk. Before that, people only looked at returns, right? But the more risk you take, the more returns that you will get over the long term. But now we want to take this further into the third dimension. We want to think about what kind of impact do you want to have? What kind of positive impact do you want to have with your investment dollars? And how do we achieve that is by thinking about your portfolio building blocks. And so in this framework, notice that I separated between fund and portfolio commitment, as well as the asset manager commitment. And notice that as you move from the left to the right, you're actually increasing your commitment to responsible investing, but it is also increasing in difficulty. So as an investor, whether you invest in single, standalone fund or you invest in a portfolio, it's very important that you understand what those portfolio building blocks look like, because responsible investing, 30 years ago, it was all about screens. I don't want to invest in certain sectors, or, these certain companies go against my values, so I don't want to invest in them. And that was perfectly fine. 30 years ago, that was responsible investing. Today, it is so much more than that. Notice that screens is only one of these 7 components. As you move from left to the right, we have integration. Integration means that when I pick a stock to invest in as an active manager, I also want to make sure that I'm considering ESG factors as well. And if the ESG factors don't match up or don't meet my standards, then I'm not going to actually invest in that company. As you move further up, there's impact. So impact, as I mentioned before, it's actually creating a measurable positive impact, whether it's on water management or carbon reduction or whatever positive impact that you're trying to achieve. And that's what impact investing is all about. It's actually putting investment dollars towards positive change. And then that next section on the right, those 3 points, that's at the asset manager level. So those are no longer responsible investing value drivers you get from investing in a particular fund. Those are commitments at the asset manager level. And what that really means is NEI investments, for example, as I showed on a previous slide, we engage in proxy voting, engagement, and advocacy. It takes a lot of resources for asset managers to do these, because you need to hire experts. You need to have a firm-wide philosophy. You need to have deep roots in responsible investing to make sure that really, frankly speaking, that you know what you're doing. And this is where, as investors, you really need to do your due diligence, make sure that you understand the manager that you're working with, because with NEI, not only do you get those components at the portfolio level, you get integration, you get screens, you get impact, but also at the asset manager level, we're very active in the Canadian market, as well as in the US with some US companies as well, making sure that we're engaging companies and helping them do the right thing. And so it's not just enough to buy an ESG fund, because let's be honest, today there's a lot of ESG funds out there. You need to make sure that you're partnering with an asset manager, whether it's NEI or someone else. You need to make sure that there's an alignment between your values and your responsible investing objectives, and align that with those of the asset manager. So last final slide, I want to show a little performance. So these are the select portfolios. There's 2 suites of select portfolios. We have the select and the select RS. So the select RS portfolios, they do have screens, value-based screens. We screen out 5 different sectors, while the select portfolios do not have screens. But all of the other value components of responsible investing can be found across both suites. So integration, impact, and active ownership. And if we look at performance year to date, Some of the portfolios most of them are in positive territory. Some are a little bit still challenged. But if you look at the 6 month, that's coming out from the market bottom. We've seen pretty strong recovery in the portfolios as well. But I think that this year, one important thing to understand is that while markets are up, so broadly speaking, if you look at the S&P 500 back at all-time highs, but if you actually look at the companies within the markets, half of them are still in a bear market, right? So I often hear that the pandemic created this kind of K-shaped recovery. Some sectors are doing a lot better than others because the ones that thrive in a physically distanced environment. But it's not over. Just because we're in a bull market, it does not mean that markets have fully recovered. And so going forward, as we see this vaccine rollout, we're going to see this rotation, and it's actually a very favorable time for active managers. And looking at long-term performance, if you look at the 5-year performance, is exactly aligned to what we would expect out of the different risk profiles. So you got your income, which is your most conservative portfolio, and obviously year to date they did well because bonds did really well. And then you have your maximum, all the way up to maximum growth, which is the most, it'll have the most stocks in the portfolio over the long term. That's also expected to outperform the rest of the portfolios. And so with that, concludes my presentation. Thank you very much. And I'm going to turn it back to David.
That was great, Yufei. And I think one of the things that's quite evident, and hopefully all the people that attended this presentation got this as well, is Yufei is a very, very smart individual. But more importantly, he's actually someone that can actually talk in easy, articulate form and really in layman terms for our members as well. So hopefully you all enjoyed that. We do have some time here for questions and for a Q&A. And one of the first questions I want to ask you, Yufei, is you mentioned ESG, and unfortunately, I don't think a lot of our members understand what ESG stands for and what it is. I was wondering if you could just quickly answer that.
Sure. So ESG and responsible investing, you heard these words kind of interchangeably. So responsible investing refers to kind of this philosophy, right, of just doing more with our dollars, thinking about impact beyond returns. ESG is the framework of how we go about being a responsible investor. So as traditional finance, we look at stocks, we look at financials, we look at income statements, balance sheets, cash flow statements. ESG is looking at those non-financial metrics. So ESG stands for environmental, social, and governance, right? So the environmental issues is obviously for oil companies, for example, there's obviously obviously an economic impact in the areas that they operate. Want to make sure that companies are making sure that they're generating their revenues sustainably, right? They're not destroying the environment as they go about doing so. Social issues, human rights, privacy issues, child labor, things like that. And then governance is really how a company is run. So this is where we look at for things like board diversity, gender equality, equal pay, and things like that.
You provided some examples already, and I'm going to stay on the ESG topic here. We've got some good questions here. Can you share an example of a proxy vote or NEI move something forward with respect to ESG?
Yeah, so proxy vote. So every year, at the company's AGM, there's a number of proxy items that gets voted. So typically, one example I could give, and instead of a specific example, I can give a general direction of every company. There's always typically there's environmental issues. So issues around climate change that show up in proxy ballots. Typically, as an asset manager, as an active asset manager, we don't want to vote in line with management on everything, because then you're not really driving change, right? If you just go along with management, then you're just really doing what's in the best interest of management. At the same time, I'm not saying that we should vote against everything or vote against management on every item. But for us, our track record has been roughly around 30 to 40% on certain climate-related topics that we vote against management. And it's actually, whereas you see some of the larger asset managers like BlackRock, for example, they only voted against management 8% of the time, right? And so, so I'm not going to get into specifics because there's just so many proxy items out there and they differ from company to company. But this is something that you can actually go online and look at, for publicly traded companies, you can look at their report and you can look at their proxy voting report. And the answers might surprise you. Certain companies that talk a lot of talk about, it's really important that, we address climate change. And then you look at what they're actually doing as active shareholders. And, frankly, a lot of them aren't doing that much.
Great, thanks, Yufei. Where are you going to be looking for additional yield, especially in the fixed income sector?
Sure. As I mentioned, government bonds, they're not giving you a lot of yield right now. And if you look at it in real terms, so you subtract inflation expectations, you're actually getting negative real yield for most government bonds across the world. I think the average, it's about negative 1% real yield. I think it's a little bit higher than that over the last couple of weeks, but you're still getting negative real yield. So where we look for is looking elsewhere, looking at the different segments of the capital structure. So government bonds, we can look at corporate bonds. So there's investment grade corporate bonds. They give you a little bit more higher coupon. We can look at high yield bonds, but obviously high yield bonds are a little bit riskier. So we have to make sure that we manage risks appropriately. Elsewhere in the world, outside of the developed world, where interest rates are a little bit higher, there's opportunities there as well. For example, emerging market debt. And typically people think emerging markets, it means it's very volatile, but actually in some parts of EM debt, such as, for example, in China bonds, they're actually less volatile than developed market bonds. And so there's a lot of opportunities there. And then of course we can, and I'm talking about one particular strategy. So this is one of NEI's funds called the Global Total Return Bond Fund. So this is you will find this across all of NEI's portfolios. And this is actually, it's a very active strategy. So it's not just about buy and hold, long government bonds and, getting 0.7% for the next 10 years. It's a very active strategy. They can, invest in credit. They can actually do currencies as well. If you think about a currency, there's a lot of currencies out there in the world. And there's a lot of value to be added if you, can make the right macro calls.
Great, thanks, Yufei. Hey, Yufei, one of your slides, I think you gave a forecast on some of the equities. And based on your forecast, would you be heavily weighted US and have limited exposure to Canada and the global equities?
Yeah, so this comes back to my point on your investment horizon, right? It's very important to get the horizon right. So when I showed on that slide, I'm talking the next 1 to 3 month kind of time horizons. Looking longer than that, at some point, presumably when we have a global vaccine, that would actually be a point you'd want to actually rotate into some of the more cyclical economies like Canada, EM, international, because those are more export driven. And when you have this virus under control and you see global trade kind of come back up and people start traveling again, those are the economies that will benefit more. And so that's when we would look to actually probably bring US to neutral or maybe even underweight. But for now, because we don't have a vaccine yet, this is all, for all we know, it's all just speculation, right? Good news comes out, but we don't actually have anything yet. And in the near term, the challenge is that, especially in the US and especially around the world, you're seeing, Europe, cases are rising all across Europe. And, in that kind of market environment, the US is still probably a safer bet. In terms of, if you want equity exposure, you do have the benefit of the US dollar. So let's say if US stocks fall, typically the US dollar actually rises. And so if you are a Canadian investor invested, let's say if you own a US fund and it's in US dollars, then the gain in US dollars can actually help offset the decline in US stocks.
Great. Yufei, you mentioned in the last few months, we saw one of the strongest stock market rallies in history. Now that the U.S. election's over, potentially some positive news on the vaccine side. What's your forecast for the next little while? Like, what's going to actually make the markets even go higher? What's the catalyst?
Yeah, that's a very good question. That's something that we're very much on top of our minds right now. I think that the vaccine news, I don't think it's fully priced in, but certainly we caught a glimpse of what that kind of what the impact on the market can look like. Should there be a vaccine that's rolled out? Over the last couple of weeks, we saw one of the strongest rotations from growth back to value, right? And for years, we've seen value underperform growth, right? For many years, and part of that is driven by the rise of tech companies, low interest rates, and all that benefits growth companies. But now, over the last couple of weeks, we've seen this rotation back to value. And value, if you think about what kind of companies are typically value companies, they're generally companies that are, call it in the kind of the old world industries, right? So you got your airlines, your industrial companies, consumer companies. These are, generally companies with steady cash flow that you would think are defensive. But however, with the pandemic, and I think, nobody frankly predicted what would happen with this pandemic, but it actually disrupted a lot of these cash flows that were thought to be stable, from some of these old world industries. And so values took even further beating, back in March and April as the pandemic struck. But going forward, we can expect, as the vaccine is made available, we can expect that rotation to continue. So even though the market, and we're still positive on stocks, so relatively speaking, we still think stocks are going to outperform bonds. But don't expect the same returns that we've seen over the last 5 months. Stocks have gained more than 60% since March. So I would not expect those kind of returns going forward. But I would still expect positive returns from stocks, and certainly more so than in bonds. But however, within stocks, if you look at this year, with the downturn and then with the recovery, is that tech has really drove outperformance of the market. So we all heard of the the FANG stocks: Facebook, Alphabet, Amazon, Google, and Microsoft. Apple. Yeah, I missed one. There's 5 of them, and those 5 companies account for more than 20% of the S&P 500. And those companies have all done really well in this kind of physically distanced world, right? So going forward next year, we're going to see rotation most likely out of tech. And so while the broad market may not rise as much as we saw over the last few months, we're still going to see probably single-digit positive returns next year. But within the market, and if you look at the different sectors, you're going to see likely huge dispersion, right? So the earnings projections next year for sectors such as consumer discretionary, for sectors such as industrials, the earnings growth expected for next year is like 70 to 80% earnings growth, right? So that's very positive numbers. And so we can see opportunities there. As active managers, you can go out and you can pick stocks. Most active managers, because of the way they manage, because of diversifying your portfolio, they typically don't have 20% of their portfolios in 5 stocks. That's certainly not, how as an active manager, you don't want to put all your eggs in one basket. But unfortunately, that was the dynamic of the market this year. Next year, as the rest of the market recovers, one, it should be a very good environment for active managers, the stock pickers. And 2 is that there's going to be a lot of opportunities within certain sectors and at the company level.
This one's not necessarily investment related, but it's sort of related. It's about credit. If someone was refinancing a mortgage this year, so it's about interest rates, would you recommend a variable rate or a fixed rate?
Oh boy, so this really differs, depending on the financial institution. I'm sure Envision has great mortgage rates. However, it really differs. It also depends on your term, how long you want your mortgage to be. But what I will say is, I'm not going to make recommendations on what kind of mortgage you should go with. But what I will say is that interest rates will most likely be pinned. Now, of course, a lot of this depends on the vaccine, right? And if the vaccine results in a faster than expected global recovery, then we could see interest rates rise sooner than expected. But the expectation as of right now is that we're going to see rates pinned till at least end of 2022 into 2023, right? So if you do want to lock in, a rate right now, I'm not talking about fixed or variable. I'm talking about, the spread between that you're getting off the prime. It's, I guess, probably not a bad time. But obviously, if a vaccine was rolled out and if the economy recovers faster, then you can see rates move up faster as well. So probably. It really depends.
No, fair enough. Before I end off, I really do want to thank Yufei Man. Yufei, that was terrific. I'm hoping some of the feedback we've received already has told us that your insights were awesome and they really enjoyed it. So thanks for taking the time, Yufei. And to all our members, thanks for joining tonight. I do believe most, if not all of you, are members with us with respect to investments. And some of you are obviously invested with NEI. So hopefully you got to hear from Yufei, who really is in charge of the strategic allocation for NEI. And hopefully you got some insights as to, not only what's happened in the past, but more importantly, what the direction we're taking in the future. So with that in mind, thank you, Yufei. Appreciate it. And thank you everyone for joining tonight. Have a good evening.